Question 7. What are the alternatives to FEPI? Here are some potential alternatives to FEPI, each offering different benefits and drawbacks. 1. Traditional technology ETFs. Examples: QQQ, Invesco QQQ Trust, VGT, Vanguard Information Technology ETF, XLK, SPDR SP Technology Select Sector Fund. Benefits. Pure capital appreciation. These ETFs aim to solely maximize capital gains by tracking various technology sector indices. Diversification. They provide exposure to a broader basket of technology companies, potentially mitigating risk from individual company performance. Established track record. They have longer historical data, allowing for better assessment of their risk-return profile. Drawbacks. No income generation. Unlike FEPI, they don't offer any regular income stream. Potentially higher volatility. Their performance is directly tied to the underlying technology stocks, potentially experiencing higher volatility compared to FEPI's income-generating strategy. 2. Income-oriented ETFs. Examples: DVY, SPDR SP Dividend ETF, SCHD, Schwab US Dividend Equity ETF. Benefits. Consistent income. They focus on companies with a history of paying regular dividends, providing a reliable income stream. Lower volatility. These ETFs often invest in sectors like utilities and consumer staples, which are generally less volatile than technology. Drawbacks. Limited exposure to technology. They might not offer significant exposure to the technology sector, which FEPI focuses on. Lower potential for capital appreciation. Their focus on dividend-paying companies may lead to lower capital growth potential compared to technology-focused ETFs. 3. Other technology ETFs with income generation strategies. Examples: JP Morgan Equity Premium Income ETF, JEPQ, JP Morgan Nasdaq Equity Premium Income ETF, PAPI Parametric Equity Premium Income ETF. Benefits. Exposure to technology. These ETFs offer exposure to the technology sector, while also incorporating strategies to generate income, similar to FEPI. Drawbacks. Different approaches. Each ETF utilizes a unique approach for generating income, requiring careful evaluation of their specific strategies and risk-return profiles. Newer options. Similar to FEPI, some of these alternatives might have a shorter track record, making long-term performance assessment challenging. Question 8. What are some key considerations before investing in FEPI? Before investing in FEPI, here are some key considerations to mull over. Investment goals. Income generation. If your primary goal is to receive a consistent income stream from your investments, FEPI's combined approach of dividends and covered calls can be appealing. Capital appreciation. If maximizing capital growth is your main objective, FEPI might not be ideal due to its limited upside potential associated with the covered call strategy. Risk tolerance. Moderate risk tolerance. FEPI's income generation strategy generally translates to lower volatility compared to traditional technology ETFs. This may be suitable for investors comfortable with moderate risk. High risk tolerance. If you're comfortable with higher risk and volatility in exchange for the potential for greater returns, traditional technology ETFs, without covered calls, might be a better fit. Investment strategy. Covered call strategy. Understand the mechanics and limitations of the covered call strategy employed by FEPI. While it generates income, it can also limit potential gains if the underlying stocks significantly rise in price. Diversification. Consider FEPI's concentration on large-cap technology companies. Ensure it aligns with your overall diversification strategy within your portfolio. Investment details. Expense ratio. FEPI has a higher expense ratio compared to some other ETFs. Compare its expense ratio with similar options to assess the cost-effectiveness of the investment. Short track record. As a relatively new ETF, FEPI has a limited historical performance record. This makes it challenging to definitively assess its long-term potential and reliability. Alternatives. Research and compare alternative investment options like traditional technology ETFs, income-oriented ETFs, or other technology ETFs with income-generating strategies. Evaluate their suitability based on your specific needs and goals. Question 9. How does FEPI manage its exposure to different technology subsectors? FEPI doesn't actively manage its exposure to various technology subsectors. Instead, it tracks the Nasdaq FANG Plus Innovation Index. This index passively invests in a basket of non-financially constrained companies positioned to benefit from innovation and technological advancements. Here's a breakdown of the index's composition and its implications for FEPI's subsector exposure. Selection criteria. The index doesn't explicitly classify companies based on specific subsectors. Instead, it focuses on factors like innovation potential, growth prospects, and market capitalization. Weighing methodology. The index utilizes a modified equal dollar weighting approach. This means companies within the index are weighted based on their notional value, aiming to provide balanced exposure across constituents. However, the weighting can dynamically adjust to maintain the desired exposure within the index methodology's constraints. Resultant subsector exposure. Due to the index's selection and weighting methodology, FEPI's subsector exposure is not actively managed and can passively shift based on the composition of the underlying index and the performance of individual companies within it. Therefore, while FEPI offers exposure to leading technology companies, it doesn't provide targeted or specific subsector allocation within the technology industry. If you have a specific preference for investing in a particular technology subsector, FEPI might not be the most suitable option. You might need to explore alternative investment options that cater to your specific subsector preferences. Question 10. How does FEPI's liquidity compare to other technology ETFs? FEPI's liquidity is generally considered good compared to other technology ETFs, but it's important to consider different aspects. Trading volume. FEPI has a moderate daily trading volume, which indicates a reasonable level of buying and selling activity. This translates to a lower likelihood of encountering significant bid-ask spreads, the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept when entering or exiting positions. Compared to well-established technology ETFs like QQQ or VGT, FEPI's trading volume is lower. However, it's important to consider the relative size and age of these ETFs. FEPI, being a newer ETF, is naturally expected to have a lower trading volume compared to more established options. Order book depth. FEPI generally exhibits reasonable order book depth, indicating sufficient orders on both the buy and sell sides at various price levels. This suggests that investors can typically enter or exit positions without significantly impacting the price due to a lack of order depth. Market makers. FEPI is supported by market makers who help facilitate trading by providing continuous bid and ask quotes. This helps maintain order book depth and improve overall liquidity. Overall assessment. While not the most heavily traded technology ETF, FEPI generally demonstrates good liquidity with sufficient trading volume, order book depth, and market maker support. This allows investors to enter and exit positions relatively easily without encountering excessive challenges. Question 11. How does FEPI's investment strategy adapt to changing market conditions and technological advancements? FEPI's investment strategy doesn't actively adapt to changing market conditions or technological advancements. This is because it passively tracks the Nasdaq FANG Plus Innovation Index. Here's a breakdown of how this passive approach functions. Index construction. The index methodology establishes the selection criteria and weighting approach for the underlying companies. This methodology is predefined and doesn't dynamically adjust based on market conditions or technological trends. Passive tracking. FEPI aims to mirror the performance of the index by holding the same constituents in the same proportions as dictated by the index weighting. Limited adaptability, as the index composition and weighting are predetermined and only adjusted periodically, quarterly in this case. FEPI's strategy inherently lacks the flexibility to actively adapt to changing market dynamics or emerging technological advancements. Therefore, FEPI's performance is primarily driven by the performance of the companies within the Nasdaq FANG Plus Innovation Index and how they respond to broader market conditions and technological shifts. It's crucial to understand that FEPI itself doesn't possess an adaptive investment strategy. Question 12. How does FEPI fit into a broader portfolio allocation for professional investors seeking exposure to technology and income generation? FEPI can potentially fit into a broader portfolio allocation for professional investors seeking exposure to technology and income generation, but it's crucial to consider its strengths and limitations within the context of the overall investment strategy. Potential benefits of including FEPI. Technology exposure. FEPI offers concentrated exposure to established technology companies, potentially aligning with the investor's desire for this sector's growth prospects. Income generation. The combination of dividends and covered calls aims to provide a consistent income stream, which can be attractive for income-seeking investors. Potentially lower volatility. Compared to traditional technology ETFs, FEPI's covered call strategy might offer somewhat lower portfolio volatility, potentially appealing to investors seeking a more balanced approach within the technology sector. Points to consider for professional investors. Limited upside potential. The covered call strategy can cap potential gains if the underlying stocks significantly rise in price, which might not be ideal for investors seeking aggressive growth. Higher expense ratio. Compared to some other ETFs, FEPI has a higher expense ratio, which can eat into returns over time. Professional investors are typically cost-conscious and may have access to lower-cost alternatives. Short track record. FEPI is a relatively new ETF, making its long-term performance history limited. This might be a concern for professional investors who heavily rely on historical data for investment decisions. Passive management. FEPI doesn't actively adapt to changing market conditions or technological advancements, which some professional investors might prefer in their technology allocation. Alternative options for professional investors are actively managed technology ETFs. These offer potentially higher growth potential, but come with higher expense ratios and require confidence in the manager's ability. Other technology ETFs with income-generating strategies. These explore various approaches like dividend-focused technology ETFs, or those utilizing alternative income generation strategies. Direct investment in individual technology companies provides greater control and potentially higher upside, but also increases risk and requires in-depth research and analysis. Ultimately, the suitability of FEPI in a professional investor's portfolio depends on several factors. Overall investment objectives. Balancing income generation with growth potential within the technology sector. Risk tolerance. Comfort level with FEPI's inherent trade-offs between income and potential upside. Portfolio allocation strategy. How FEPI complements other holdings and aligns with the investor's broader asset allocation strategy. Availability of alternative investment options and their comparative analysis. Alright everyone, that's all the time we have for FEPI today. Remember, FEPI offers a unique blend of tech exposure and income generation, but it comes with its own set of trade-offs and limitations. Carefully consider your investment goals, risk tolerance, and portfolio allocation before making any decisions. And as always, consult with a financial advisor for personalized guidance tailored to your specific situation. For more in-depth discussions on exciting ETFs and investment strategies, be sure to subscribe to Chat ETF and hit that notification bell so you never miss an upload. Thanks for joining the conversation. Until next time, happy investing.